So the NASDAQ is officially in correction territory, and we've had more market volatility than we've seen in a few years. And I'm not saying a bear market is certain, nobody has a crystal ball, but given the markets are volatile, it's a really good reminder that the market does not operate going up in a straight line. It has bumps along the road, and truthfully, that is a good thing, because if it went up in a straight line, there would be no opportunity for growth. However, it is important to begin preparing for a bear market or a recession before they actually happen. So in this episode, I'm going to discuss 14 retirement planning moves to help you prepare for the next bear market, because it is not a function of if, it is a function of when. But first, hello everybody, and thank you for joining for another episode of the Planning for Retirement podcast. My name is Kevin Lau. I'm your host. I'm also the owner and financial planner at Imagine Financial Security. We help individuals over 50 with over 7 figures maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If this describes you, make sure to follow our show and make sure to subscribe to the YouTube channel. We put out weekly content, retirement planning related, specifically designed for you, what I like to call PFR Nation. And of course, if you're interested in working with our firm one-on-one, you can visit our website at www.imaginefinancialsecurity.com, or you can simply start with the retirement readiness questionnaire linked in the description. So why don't we talk a little bit about the definition of a bear market first and foremost? I think this is important just to kind of distinguish what it is. So simply put, it's a 20% drop from a previous high. And I mentioned we're in correction territory. So what does that mean? What a correction is a 10% decline from previous highs. So that's the simple definition there. So since 1964, just for historical context, the S&P 500, okay, because, you can have a correction really related to any of the major indices. I mentioned the NASDAQ's in correction territory, but the S&P 500 is not yet, okay? But since 1964, the S&P 500 has experienced 27 corrections, and 8 of those corrections led to a bear market. So 27 times the market dropped by 10% or more, and 8 of those 27 times, or roughly 30% or so, dropped by 20%, okay? So they happen quite frequently is sort of basically the gist of it. And typically they last on average about 10 months, okay? But we've had some that have lasted significantly longer to that. If we think back to the Great Depression in the 1930s, late 1930s, 1939 to 1942, that bear market lasted almost 3 years, okay? I would say the most severe bear market on record was during the Great Depression at the very beginning when the stock market dropped in 1929. So from 1930 through 1932, the Dow dropped 86%. I mean, can you imagine that? Okay. Most recently, the most recent bear market we saw was in 2022. We had multi-decade high inflation rates, just over 9%. We had rising interest rates and overall just tightening of the money supply. And that one was tough. I mean, I would say that was one of the most difficult bear markets I've coached clients through, truthfully in my career. I started in 2008, 2009, but I was brand new. It was the very beginning. I was more the support role and sort of supporting some of those lead advisors that I was watching do the work. And so I saw them coach clients through that period of time. But I don't really think I understood the significance of that recession. So 2022 was legit. I mean, because that one was interesting. Typically when bear markets happen or recessions happen, you have stocks drop, but then bonds actually go up in value. Well, in 2022, we had stocks drop over 20%, and then bonds dropped almost 15% that year. So there was really nowhere to run at that point in time. And there was a lot of learning lessons there, for folks about bonds and the role they play in portfolios, but also the risk that bonds have within the context of diversification. It doesn't always work perfectly in terms of this inverse correlation between stocks and bonds. And that's truthfully why a lot of people want to have bonds in their portfolio, is because they are, historically speaking, inversely correlated. But that's why you really need to pay attention to the duration, the maturity levels of those bonds, because they can also decline in value depending on what interest rates do. Arguably, the worst recession that we saw and the worst bear market that we've seen in our lifetime was, of course, the global financial crisis in 2008. That decline was about 56% from top to bottom, for the S&P 500. Okay. I mean, obviously we had, banking system failures. We had the subprime mortgage crisis. I mean, there was a lot of ugliness in the financial system during that period of time. And that led to a significant sell-off, terrible recession. Before then, we had the dot-com bubble, okay, where 2001 through 2002, we had the S&P 500 decline about 50% and the NASDAQ dropped almost 78%. Because it's overvaluation of tech stocks and sort of this euphoria of sort of just throwing money at anything that had .com at the end of it. Okay. 2020, that was another bear market during the pandemic. That was very short-lived, but we had a decline of about 34% for the S&P 500, really from the beginning of February through March of 2020. But then it fully recovered 2 months later in May. These bear markets are, they show up, and typically you don't know. These corrections happen and you're like, hey, are we going to enter a bear market or recession, or are we going to recover from this and continue on a bull run? You just do not know. No one has a crystal ball on this. And that's why I'm recording this right now. This is March 13th. And I'm saying, hey, we're in correction territory. I'm not sounding the alarms in terms of, hey, we're definitely going to go into a recession. But I'm certainly seeing a lot of the indicators out there and a lot of the experts that are pointing to potentially a recession in 2025. And just understand that this is part of the economic cycle. Okay, we go through booms and busts. We go through expansions. We go through contractions. We hit peaks, we hit troughs. Okay. And there's a lot of concern right now in the markets that I've talked about on the podcast before. So I'm not going to beat a dead horse, but obviously we've got the tariff and the impacts there on prices. We've got geopolitical conflicts, right now going on in the Middle East, as well as, with Russia and Ukraine. We've got inflation still hot, although, it's a little bit of signs of cooling there in the February reading, which is great. And then we have this interest rate issue here where, the Feds have cut interest rates, but interest rates have kind of remained relatively high. So there's good and bad, especially related to UPFR Nation, that we could take advantage of. But there's a lot of uncertainty right now. And I think more so than we've seen in the last couple of years. And so we're hearing from a lot more of our clients about this volatility, a lot about the uncertainty and about a potential recession, about a potential bear market. So I guess I'll first just kind of say this to all of you listening, is that this is normal. Okay. So if you're questioning what's going on, if you're feeling concerned, if you're feeling scared about the future, this is 100% normal. And I've talked about the idea of DERP before in the podcast, discipline, unemotional, repeatable process. But that's just me sort of saying, okay, this is the logical side speaking to all of you to make sure, hey, well, let's not make emotional decisions when things are volatile, but it's normal to feel emotions. Okay. It would be concerning if you had no emotions, but ultimately it's normal to want to ask questions. And I think this is why I wanted to brainstorm this episode at this juncture, because, we're in this volatile time. We could slip into a bear market or a recession in 2025. But again, I don't know for certain, but I brainstormed 14 things that you all PFR Nation could do to prepare for the next bear market. Because I mentioned at the beginning, it's not a function of if, it's a function of when. So why don't we dive into these? And we're going to go kind of rapid fire in this one because there's a lot of points here. But the first one I'll just throw out there is preparing your mindset. Okay. I think, very simply put, some of the data points and the facts that I threw out at the beginning, this is why I did that, is because I want you to prepare mentally that, hey, bear markets, this is a normal part of investing. You didn't get to where you are today, cracking 7 figures or multiple 7 figures, being scared of investing. Okay. You had this mindset of like, hey, I'm going to take on the risk. I need to achieve the desired rate of returns. But then the challenge is, the closer you get to retirement, the more volatility kind of spooks you a little bit, because you're like, man, I'm getting closer to needing to live on the portfolio as opposed to just in accumulation mode. So no question, I think there is some value of reevaluating your investment strategy. And we're going to talk about that here in a second. But it's very, very common for folks as they get closer to needing the money to reevaluate that investment strategy. And that's why the role of safer investments, and that's how they fit into the context of the overall picture. But again, bear markets happen on average about every 5 years. So kind of just prepare your mindset. Even when you retire, doesn't mean that you're going to stop investing in the stock market, because you need to keep pace with inflation. We've talked about inflation. The only thing that keeps pace with inflation over the long term is investing in the stock market. Okay, real estate, you can throw that in there too. But bonds typically barely keep pace, maybe even lag inflation just a little bit. And so if you have a 30-year time horizon, you can expect to live through 6 bear markets during retirement. So just prepare yourself. And I think the second one, which is prepare your investment portfolio for the next bear market, is super, super critical. Okay. So in this one, number 2, the prepare your investment portfolio, it's much easier to say this now because obviously now we have volatility. But when things are really good, okay, kind of rewind the tape a little bit. We had 2023, the S&P 500 was up, I think, 25%. Or maybe it was 23%. And then 2024, it was up about 25%. Okay, so we had back-to-back years where the S&P 500 was over 20% returns. Now, that was coming off the heels of 2022 when things weren't good. So we've kind of had this up and down of the S&P 500, which is truthfully pretty normal. But ultimately, what happened, obviously, at the end of 2024, we had Trump win the election. We had this almost kind of euphoria continue on where it's like, we've had great returns in the market. And now Trump is going to come into office and, cut regulation, cut taxes, stimulate manufacturing here domestically, drill, baby, drill. We're going to have the economic backdrop is going to look so good. So we had this Trump bump right after the election in November. And I just kind of felt like things were running a little bit hot. And that's very, very normal towards the end of a boom. Okay. Where, people are just sort of, the FOMO kicks in, fear of missing out. And, I think instead of riding that wave, this is why I talk about disciplined, unemotional, repeatable process. That rebalancing process kind of prevents you from doing that, prevents you from sort of acting on emotion to say, oh, hey, my tech stocks have been done pretty well. Even though I'm way overexposed into tech, I'm going to just continue to let that ride because look at all this investment into AI. Well, look at the NASDAQ so far in 2025. That was the first thing to start to sell off because of the overvaluation on paper, technically speaking, that these big tech companies have relative to their earnings and ultimately what their price should be, according to the experts. But I think rebalancing the portfolio and continuing to stay disciplined, trimming those winners, taking the gains off the table, not abandoning the winners, but trimming some of the winners and then buying some of the losers that are potentially underweight in your portfolio. But you can't do that unless you have specific targets for each asset class. You can't just magically come in the middle of a bear market and say, okay, now I'm going to rebalance. And, what do I think is going to happen with the market? That's not how it works. You need to come into each year with a defined investment policy statement and a defined investment strategy for each account. Your taxable brokerage account, your traditional IRA, your 401k, your Roth account. And you need to have a defined process to say, okay, when my percentage deviates by this amount, let's say from large cap stocks, let's call it the S&P 500, that is when I'm going to either buy or sell. So if valuations went up significantly, like 2024, I'm going to take some of the gains off the table in the S&P 500. I'm going to go buy out some of the things that may be underperformed, like fixed income, save for investments, maybe even add cash to your portfolio. Okay. So you can't have a rebalancing strategy unless you have a specific investment target for each of your portfolios. But I think that is really my plea to all of you is once you have that specified investment strategy, continue to rebalance that. Don't just kind of let it ride and then sort of let emotions or that euphoria kick in and say, oh, I'm going to kind of wait. I'm going to wait until these gains continue. You never know when things are going to turn. And typically when they turn, it happens pretty quickly. So if you miss out on that opportunity to rebalance at the beginning of the year, I would say it's not too late, but obviously some of that sizzle has been taken away because the market's been flat since November. But it's better late than never. Okay. It's better doing it now versus when the market's down 30 or 35% on the NASDAQ. Okay. And I keep focusing on the NASDAQ because that was really the primary asset class that we trimmed at the beginning of 2025. Looking at globally across all of our client portfolios, that was the one thing consistent with every single client account was they were significantly overexposed into big tech, obviously because of the run up with AI and the expectations there with returns. And I don't think that's going anywhere. But again, the volatility factor and being overly exposed into one asset class, that's where things can get a little uncomfortable. And if you have a defined investment strategy and a defined process, that should reduce some of the anxiety over the long term, at least from my experience dealing with clients. Number 3, I really, really like this one. It's building up your war chest. So war chest, for me, I like to call my cash on hand or any sort of cash alternative like bucket, building up your war chest. So of course, if we enter a bear market, there is a decent chance we are already in the middle of recession. Okay. But the market's a leading indicator. So it's not like we know for sure when the recession's going, like if we hit a bear market and all of a sudden it's like, yes, we're in a recession. It's typically like the market expectations go down, market begins to sell off. And then after those two consecutive quarters of negative GDP, then they announce, okay, we're in a recession at this point in time. So you don't really know if we actually had a recession until several quarters down the road. But ultimately, it's very likely that if you hit a bear market, there could be a recession either already or very, very soon. And so if you have cash on hand, that could help you just in case you lost your job or, maybe your employer's cutting bonuses or they're cutting pay. But if you're lucky enough, so that emergency fund is super important. But if you're lucky enough to keep your job during a bear market, cash is king. Looking for buying opportunities when things are volatile. Okay. I go back to the Warren Buffett quote that I love to say. I don't love the verbiage on some of this stuff, but But the quote is, be fearful when others are greedy and be greedy when others are fearful. Okay, I don't like the fear and greed play, but ultimately what he's trying to say is when people are so overly optimistic about the markets, typically it's at the tail end of a cycle. So be a little cautious there. Build up a little bit of that cash war chest. Think back to the end of 2024, optimism with the election, optimism with the S&P 500, back-to-back 20+% returns. Build up some of that cash buffer and wait, because at some point it's going to happen. The bear market's going to happen. Corrections are going to happen like we have right now. And that could create long-term buying opportunities. Just because you're near retirement or already retired doesn't mean you can't buy up opportunities. That could be cash within your investment portfolio or a cash alternative with your investment portfolio. But if you're still working, that also means adding funds to your retirement accounts, 401k contributions, Roth accounts, HSAs. Okay. Use some of that income that you're generating from your employer or self-employment income to add more cash to the portfolio during those downturns. Okay. So that could be increasing your savings rate. It could be front loading contributions. Like maybe you build up a little cash in your bank and you're like, all right, hey, now all of a sudden we're in a recession. Instead of waiting until for the next 7 months to max out your 401k plan, maybe you start to throw in some larger contributions over the next month, 2-3 months to take advantage of some of those buying opportunities. In other words, buying the dip. Okay. So it could happen with your savings rate. It could happen with cash within the portfolio. But again, it's not going to feel normal to do this. All right. Again, you kind of think back to some of the downturns we had. I mean, during COVID, okay, I always remember the pandemic and, just the conversations that we were having with clients at that point in time. It was very counterintuitive. Like I remember in March and April, the market had already dipped significantly, 30+%. And I remember the market bottom happened at my wife's birthday, March 23rd of 2020. And actually, we were fortunate enough. We just totally got lucky, but we added cash into our investment portfolio on that day. I just thought, hey, it's my wife's birthday. Let's just pick this day to buy in. I didn't know if that was going to be the bottom. We just got lucky. But, ultimately, it's not going to feel normal to do this, okay? Because feelings are going to be at the forefront. I mean, think about the pandemic. Like, imagine the conversation logically, me telling clients, hey, guess what? The market's down 30 to 40%. I recommend you add more money to your portfolio, add more cash to your portfolio. People are like, are you kidding me? I want to take money out of the stock market. Okay. But I throw this out there. I'm going to throw this Hartford Fund study stat out there. This is one of the most eye-popping, or actually two of the most eye-popping stats that I've seen with regards to bear markets. Listen to this. 56% of the best days in the S&P 500 occur during a bear market. Another 32% of the best days in the S&P 500 happen in the first 2 months of a bull market. So basically, 88% of the best days in the S&P 500 occur when things are not really good. Nobody's feeling optimistic about investing. Going back to the Warren Buffett quote, going back to the Michigan consumer confidence study that I reference all the time. Like when consumer confidence is low, that's when you kind of want to buy. When the VIX is high, time to buy. Okay. Ultimately, when the VIX is high, time to buy. When the VIX is low, it's time to go. One of my favorite little sayings as well that I've learned over the years. But these bear markets can create some significant wealth building opportunities. Whether you are approaching retirement or already retired, this could help salvage your longevity of your portfolio 5, even 10-fold if you do this the right way. If you do it the opposite way, if you act on emotion and sell out of stocks after a downturn or correction or recession, then you run the trap of timing the market. And then what happens is now you're waiting. Okay, now you sold out. Maybe that helps you sleep well at night for maybe a few weeks. You're like, okay, I'm so glad I did that. Things are so volatile. I'm so glad I'm out of the market right now. My portfolio is just going to stay level. And then all of a sudden, the stats I just threw out there occur. 56% of the best days happen during the bear market. So things are bad. All of a sudden, half of the best days in the S&P 500 are gone. Now, another 32% happened during the first 2 months of a bull market. So all of a sudden now, the news stories start to change. After that first 2 months of a bull market, hey guys, look at the S&P 500. We've had a crazy rally. Now we're in a bull market, 20% rally. Okay, now what are you going to do? Are you going to jump back in at that point in time? Or are you going to say, oh my gosh, like now things are a little bit heat, or hey, I'm going to wait to see what happens. Now, when are you going to get back in? The market timers, the downside is you have to be right more than once. You've got to be right on when to get out and then when to get back in. That is very, very difficult to do on a consistent basis over a 30-year time horizon. That's why we don't try to do that. We're not betting our client portfolios, okay, with how we feel about the markets. That's why I talk about the disciplined, unemotional, repeatable process, okay? If you can do it right, add that cash in at the right opportune moment, rebalance the portfolio, you're really going to, and having those set investment targets are going to help you with those decisions, okay, of when to add cash or when to rebalance your portfolio. If you don't have the investment strategy, it's pointless, okay? That whole bullet point is totally worthless. Number 4, have a plan for where your retirement cash flows are coming from. This is super important, okay? This is something I've been talking to my clients about a lot over the last month or two, especially the ones that are drawing from their portfolio, okay? You got to think of the context of, okay, where's the cash flow coming from? Let's say you need a certain dollar amount. Let's say you need $40,000. And let's say you have $1 million, okay, to keep it real simple. So that's maybe 4% of your portfolio, okay? Well, let's say you're invested 60-40 and $400,000 is in the fixed income side of your portfolio and the other $600,000 is on the equity side. So while the equities are volatile, you can remind yourself, hey, I have a backdrop here. I have $400,000. And if you take, let's assume no interest payments on that $400,000, which obviously we know there are interest rates. I mean, the 10-year treasury right now, last time I checked, was sitting at about 4.3%. Pretty attractive, from my standpoint. Okay. So $400,000 is in fixed income. Let's assume zero interest payments. Well, if you take $40,000 and divide that into 400,000, you actually have 10 years of income in fixed income. Okay. So basically for 10 years, you can live in retirement without having to touch any of your stock portfolio. We already looked in the context of the historical speaking, how long bear markets last, about 10 months, the longest. I would say 2008, that's the longest we've seen in our lifetime. That lasted about 5 years, a little over 5 years, but not 10. So if you have 10 years banked in fixed income that can essentially satisfy most of your income needs over the next, that should make you feel pretty good. That's how I've been framing up a lot of these discussions with clients is like, okay, yes, your stocks are volatile, but the bonds are holding steady. And by the way, they are generating cash flows. We just pointed that out. 4.3% in a 10-year treasury. Let's say you're earning about 4% on that particular side on that 400,000. And let's say you're also earning some income on the stock side via dividends. Okay. Maybe not all of the stocks you own pay dividends, but maybe a good chunk of them pay dividends. And let's say if we look at everything in the portfolio in terms of the income or cash flow as it's generating between stocks and bonds, let's say combined, it's 2.5% on the low end, which is pretty realistic today. And let's say your rate of withdrawal is 4%. You only need to rely on capital sales for about 1.5% of your portfolio. That's not too painful in my eyes, okay? So if you kind of frame this up in terms of, okay, where's your cash flow coming from? Do you have an individual bond ladder? Do you have a disciplined process in terms of taking income from your portfolio and what you're selling at what points in time? So during 2024, when our clients were generating income from their portfolio, yes, they have the cash flows from interest payments. They had the cash flows from dividends, stocks that pay dividends. But we also needed to sell some things to generate the rest of our clients' income for the majority of them. What were we selling in 2024? We were slowly trimming off the gains from the equities, the S&P 500 predominantly, okay? International did pretty well too, but ultimately S&P 500 was the top dog in the stock market last year. So we were just taking some of those gains off the table. So we weren't even waiting until the end of the year to do a rebalance or the beginning of the year. We were slowly trimming off those gains as we received them to generate that retirement paycheck for our clients in 2024. Well, now the tide's shifting a little bit, 2025. Where do you think we're going to be generating that additional 1.5% for capital sales? Fixed income or cash alternatives, short-term bonds. Plenty of money in our clients' portfolios that we have invested in that particular strategy that we can pull from while stocks recover. Super, super important to know where that retirement paycheck is coming from. And we're going to talk more about that retirement paycheck right now with Social Security planning. And we've hit on Social Security several times over the last few weeks and understanding how important that timing, the decision of when to draw Social Security. It's very difficult to nail down perfectly. Don't stress about coming up with the perfect answer, because at the end of the day, that involves knowing exactly how long you're going to live. But once you throw in the assumptions, if you plug in some reasonable assumptions, that hopefully should guide you in the right direction of when to claim Social Security. But one of the things to think about, if you delay Social Security as long as possible, let's say until 70, or let's say maybe delayed until full retirement age, you have a much higher benefit base, a starting point that's also going to receive those cost of living adjustments. So you have essentially a higher income floor in retirement than if you had started early. Okay, so that's a very important thing to note, is that, that income floor is what we like to call it, is super, super important during times of volatility, because it gives retirees that peace of mind of like, hey, 60% of my cash flow need is coming from fixed income sources. So I only need to rely on 40% of my paycheck to come from my investment portfolio, which is volatile. So Social Security is a big part of that. But if you've already, let's say you retired and maybe you're planning to delay Social Security until 70, and we hit a bear market or we hit a recession, things got really bad, you could elect to start Social Security benefits. And then you could elect to continue them indefinitely, or you could elect to stop them at full retirement age and then preserve those delayed retirement credits post full retirement age until you hit 70. So you can still kind of do that claiming until, or that delay until 7 strategy by doing the start stop, or you could just start it and then continue on. If you just felt like, hey, you know what, I kind of like my Social Security payments, I'm just going to continue to receive this, and then we'll supplement it with investment income. But claiming that Social Security benefit or whenever you claim could really create that guaranteed income floor and reduce the pressure you're going to have on your investment portfolio during times of volatility. Number 6, I'm going to throw this in there. You may not like this one, but it's considering part-time work. Okay. I think at the end of the day, the goal when most people retire is they want work to be optional. Okay. They don't want to be forced to go back to work. And now we're talking about going back to work. And so maybe not even mathematically speaking, you need to go back to work in order to preserve your portfolio, but maybe just like peace of mind wise, you're like, all right, instead of bleeding down my portfolio while we're in a bear market, while we're in a recession, maybe you try to do something for a little bit of income in the short term. Maybe find something that's fulfilling work that, maybe it can a little bit of a side hustle just to, again, reduce that rate of withdrawal, put less pressure on your investment portfolio. So that's number 6. Number 7 is an interesting one. Okay, so number 7 is Roth conversion. So considering Roth conversions during a downturn. So Roth conversions, we talked about Roth conversions, the benefit there being you've got money in a pre-tax account, and you decide based on your long-term goals and based on how, your tax brackets shape out throughout the duration of your lifetime, you decide, you know what, Roth conversions make sense to me. Well, when you're converting Roth, okay, when you're converting dollars from the pre-tax to Roth, you're obviously going to have to pay taxes. But ultimately, if you kind of think about it, it's like a certain dollar amount is being used at this point in time in your pre-tax account. And that certain dollar amount can own a certain number of shares of some investment that you have, okay? And if the value of those shares goes down, you still own that amount of shares, okay, or those amount of shares, okay? And at some point, if you believe those investments are going to continue to do well, you're like, hey, I'm not going to abandon my S&P 500 positions. Like, these are great companies that I have every bit of faith in the world that they're going to ride the storm and be very, very profitable in the long run. You're like, I want to continue to hold these. Well, if the valuations are down, you could say, you know what, I'm going to go ahead and start to do some Roth conversions then. Because at some point when they recover, I'd much rather have that recovery happen in the tax-free bucket than the tax-deferred bucket. So essentially, it could create some opportunities where those Roth conversions could actually create a little bit more meaningful in terms of rates of return. The challenging part is you got to kind of time it perfectly. It's like you got to do the conversion at the right time, because on the other hand, you could do the conversion and then now the money's in the Roth and then it continued to go down further from there. So it's like, it's kind of a market timing thing that I don't love, but like in general, if the market's down 20%, potentially a good thing to evaluate. We like to typically do Roth conversions towards the end of the year. So that's another challenge, because that way we kind of have it. We can't guarantee, but we have a really, really good idea of what our client's income is going to be at that point in time. Like, we know what the dividends look like. We know what interest income looks like. We know of employment income, if any, or pensions or Social Security. We can add all that in and have a pretty good idea of where their taxable income is going to be and how much room they're going to have in certain tax brackets. So if you do it early in the year, you're kind of guessing. So I would say like maybe be a little bit conservative if you're doing some Roth conversions earlier in the year, to give you kind of some wiggle room towards the end of the year to either do more conversions or say, you know what, well, you hit the nail on the head in the beginning of the year. But those Roth conversions could be something that you do during a downturn, during a bear market, to, again, take advantage of that money that recovers. When it recovers, now it's in that tax-free bucket. All right, number 8 is gifting stock or securities at a discount. Okay, very similar concept here is that, hey, you have let's say you've you have some investments, some stock or mutual funds or ETFs, and you gift regularly to family members or an irrevocable trust, whatever that might be, or even charity. Okay. I mean, charity is a little different though, because they don't pay taxes anyway. So it's a little, I think more the gifting to family members could make a lot of sense in this one, where it's like, instead of gifting them stock with prices that are much higher, you could gift them stock when the values are down to essentially allow for a lower gift. But then ultimately that's going to appreciate, and that gain is going to be on their balance sheet as opposed to yours, or their tax return as opposed to yours. So I think it's one of those things that could be valuable, but maybe not. I don't know if the juice is worth the squeeze on that one. It really just depends on how much you're gifting to your family members and ultimately how much of a loss that particular investment is going to be, and also the long-term outlook of that particular investment. Number 9 is, I think, an obvious and a really good one, is tax loss harvesting. So for those of you that are not familiar with this, basically tax loss harvesting actually involves selling something at a loss. Okay. And that actually sounds counterintuitive. We're talking about buying low and selling high. But in this case, what we're doing is we're turning a paper loss into a realized loss. And we're doing that inside of a taxable brokerage account. So not inside of an IRA or a Roth account or a 401k, because anything you sell in those particular accounts, like the tax implication is not going to matter because you're selling it inside of a tax exempt account. The only time you're going to pay taxes is if you actually take a withdrawal from the portfolio. But if you're simply rebalancing the portfolio, that's not going to trigger any taxes inside of those qualified plans. Whereas a taxable account, or maybe what I would consider to be a non-qualified account, anything you sell, it's either going to trigger a gain or a loss. And so if you have something that's a paper loss, maybe a great investment that you love, maybe it's exposure into large cap tech companies. Maybe you've got exposure into big tech. And you're like, hey, I really like these positions. I want to realize the loss to realize it for tax purposes. Okay, but I also want to stay in those positions long term. Like I don't want to bail out at the bottom and then now the market recovers and I miss out. This is where tax loss harvesting comes into play, where you can turn that unrealized loss, sell that particular investment or multiple investments. Now you have a realized loss. And those realized losses can be used to offset capital gains in that current year or in years in the future. So you can carry forward those losses. So you can almost kind of build up a little bit of a war chest during periods of volatility to use to offset capital gains in the future. And if you have no capital gains in the current year or in future years, you can deduct up to $3,000 against your ordinary income, which is kind of nice. Okay. So during periods of volatility, I mean, the last bear market we had, 2022, we built up some pretty nice war chests for a lot of our clients that had taxable accounts. And now they're still using some of those carry forward losses to either offset capital gains or just use that $3,000 a year ordinary income tax deduction. Okay. But now the key though is once you realize that loss, again, going back to the point of like, I don't want to sell low and then now the market recovers and now how am I going to ride the wave? Well, then what you want to do is you want to go ahead and replace that security right away. But you want to replace it with something that's not substantially identical is really the terminology they use. There's a little bit of gray area here, but I think at its core, it's got to look a little differently than the investment that you sold out of. So you can't say, okay, here's Apple. Apple's down. I'm going to sell Apple for a loss and then turn around and buy Apple. That is substantially identical. But you could sell Apple and then turn around and buy Microsoft. That's not substantially identical. I mean, it's a similar security, but it's not substantially identical. So stocks are pretty cut and dry. Bonds are pretty cut and dry. But what about funds? What about like ETFs or mutual funds? That becomes a little bit more murky there. I think one way to sort of play it is sort of switch the fund family. So if like you're using an S&P 500 fund with Fidelity, you could bail out of that one, take the loss, and then buy into maybe an S&P 500 fund that's more actively managed, maybe within Charles Schwab or Vanguard even. Okay, so you can try to still get similar exposure to those companies that you sold out of if you use ETFs or mutual funds, but again, not buying something that is substantially identical within 30 days. After 30 days, you're good. You can go and replace that position and buy back to that position. But if you do that within 30 days, it's going to trigger what's called a wash sale rule. And you're not going to be able to use those losses to offset capital gains or deduct against your ordinary income in the future. But tax loss harvesting is a great strategy during periods of volatility. The challenge, though, is if you're coming off years, like back-to-back years like we had in 23 and 24, where the S&P 500 was significantly positive, 20%, and then it goes down 20 or 15%, you probably still don't have losses in the portfolio unless you're continuing to add money to the account. So if you're dollar cost averaging into a taxable brokerage account, you probably have some losses that you can realize right now. Okay. Or worst case scenario, maybe you bought in with a large lump sum in the fall of last year and you're like, now you're sitting on pretty significant losses. You can go ahead and start leveraging tax loss harvesting right away. Number 10, create guaranteed income via fixed annuities. So leveraging the power of annuities. Again, I mentioned this before, like Social Security is an annuity. Okay. At the end of the day, like we all have annuities, we all have Social Security. Okay. But outside of that, let's say that income floor is something, maybe it's that Social Security payment, or maybe you haven't even started Social Security yet. Maybe you have no income floor. Okay. I think this is where annuities shine. Okay. Is during periods of volatility, psychologically, okay, I've got my Social Security check, I've got my annuity check. At least I have a baseline. And the higher that baseline is, the higher that guaranteed income floor is, just the more peace of mind you're going to feel with your investment portfolio. Because hey, yes, things are volatile, but I've got 60% of my income is being covered. And most of that is just my regular expenses are being covered by my guaranteed income sources. I don't care what the market's doing in the short term. So this is where I believe annuities come into the picture and should come into the picture. Okay. And this isn't even some hot take to pitch annuities. We don't even sell annuities. Okay. But we believe that they fit into an overall retirement income plan and they should be considered. We just flipped the switch with a client with an annuity at the beginning of this year. She had this annuity that she was just accumulating. It was just in the accumulation mode. She wasn't leveraging it. And we said, hey, Mary, let's go ahead and turn that income switch on. Let's maximize that payout rate, because the payout rate she got from it was 7.6%. There's no way we were going to draw 7.6% from that particular asset class. Okay, that would be way above that 4% rule benchmark. But 7.6% was the payout that's guaranteed for her entire lifetime. And there's a 15-year guarantee period where she passes away within 15 years. That income stream will continue to her son. But I'm telling you right now, we talked to her yesterday. That is providing her more peace of mind during these times of volatility, because she's got the Social Security check. Now she's got that additional income from the annuity. I mean, it's upward of 70% in terms of what her cash flow needs are coming from those guaranteed sources. So I think the more you can create that fixed income floor, the better you're going to feel during times of volatility, like a bear market or worse, a recession. All right, number 11 is an interesting one. This is leveraging cash value life insurance and the benefits of cash value life insurance. Now, this only works if you already have cash value life insurance. You can't all of a sudden magically build up a huge war chest within your cash value life policy overnight. I mean, it takes years and oftentimes decades to build up these significant cash values in your policy. I mean, I've been paying into my policy now close to 17 years. So I built up a nice little buffer in my life insurance policy. And I've actually leveraged it during times of volatility. Actually, speaking to that March of 23rd, 2020 buy that I talked about, that actually came from my life insurance policy. I maxed out a policy loan for my life insurance because I just thought this is a buying opportunity. I'm going to max out my life policy loan and I'm going to buy into the stock market right now because I just believe in the longevity of the US stock market. I'm going to go ahead and buy these discounted prices. So if you have cash value in your life insurance, you could potentially use it almost like a cash alternative during periods of volatility. So you can avoid selling, let's say, some of these equity positions that are down in value. Or maybe we go through a market like 2022. Remember, stocks were down 20% and also bonds were down 15%. If you have life insurance, those are not going down in value. If it's a traditional portfolio-based cash value policy, every year you're going to continue to receive increases via the dividends and your cash value is not going to go backwards. So you could temporarily tap into that cash value, whether it's withdrawals or partial surrenders or policy loans while the market's recovering. So it could just act as another cash alternative or an annuity alternative, if you will. And along those same lines, number 12 is leveraging a home equity line of credit or reverse mortgage. So essentially tapping into your home equity. So again, we kind of talk about the home equity piece as a last line of defense. But if you've got significant home equity on your balance sheet that you're not leveraging, like you could tap into it via HELOC. You don't have to use the HELOC right away, but you could just open the HELOC before things get bad. And now you've got maybe $100,000 or $200,000 in a home equity line of credit that's available to you as cash. Obviously, there'll be interest associated with it if you actually tap into that cash bucket. But if things got really, really bad, it could be something that you use as kind of like a pull the lever type of thing and sort of like the last line of defense. And then if you're over 62, you can qualify for the reverse mortgage scenario where you could also not use it as an income source, that reverse mortgage, but essentially create a cash bucket very similar to the home equity line of credit using the HECM strategy with a reverse mortgage. So again, you need to talk to a mortgage broker that understands these products. I have a general understanding of how they work. And I think the home equity piece is probably something that's one of the most underutilized asset classes. And just having that cash buffer available, creating liquidity within your home equity can really create a lot of peace of mind if things got really, really bad in the stock or bond markets. All right, number 13, getting closer to the end. So thanks for sticking with me. Number 13, trimming concentrated stock positions. Okay. So when we deal with the client, we do this all the time. We deal with clients that have significant concentrations in their stock positions. Okay. It's very tough to sell out of it at that point in time because there's two reasons for that. Number one is behavioral. It feels really good. Like this is something that has helped them build wealth, significant wealth. Maybe they worked for Microsoft for several decades. Maybe they worked for Google or Apple or Amazon, one of these big companies, or JP Morgan, and they've got several $100,000 in this one company. And they know, listen, it's a great company, but they know they're a little overweight in this particular position. They'd love to sell it, but again, it got them to where they are. But then the second part is there's significant tax consequences of doing so. Okay. Well, in times of volatility, those stock prices are going to come down. It just makes that pain a little bit less painful. All right. So instead of paying, maybe $100,000 in taxes, maybe the tax bill is maybe $50,000 because of volatility that you had in that position. Maybe that's a time to begin trimming some of those positions. Or maybe there's a bunch of different tranches of that particular position that have variance in terms of their cost basis. Maybe some of those actually are at a loss now or very little capital gains. We're dealing with this right now with a client of ours. Actually, I'm meeting with him later on today. He works for Microsoft, significant Microsoft stock, upwards of, I think it's about 45% of his investment portfolio is in Microsoft stock. He knows he wants to trim it. When we first started working with him, though, he was just, the tax bill. Now he's getting closer to retirement. And now he sees that 40%. We've been showing it to him on the financial plan, 40% concentration, 45% concentration. So now that we've got some volatility, we actually can look at trimming that position by about 10%. So going from 40 down to 30% and have very, very little capital gains because of the volatility that we've had in the stock market. So again, if you've got a concentrated position, at least from my lens, is anything over 5% exposure, it could be a really, really good time to review those and see if there's some opportunity to begin to trim, get closer to an allocation that makes sense for you and that you're comfortable with long-term and have a lower tax bill. All right, number 14, last but not least, ladies and gentlemen, you can do nothing. So remember, listen, it's okay to do nothing because acting with emotion or making a rash decision during times of volatility, this could really screw your plan up long term. So I would say it's much better just to kind of bury your head in the sand during these times. Like if you're uncomfortable with all of the 13 things that I mentioned before, and you're just like, I just don't know what to do, probably better to just bury your head in the sand and not make any rash decisions unless you just totally lack a financial plan and strategy to begin with. If that's the case, you definitely need to consult with a professional, but you can certainly wait it out and do nothing. And I would encourage you, if you're in that situation, reach out to your advisors or reach out to a professional, find an advisor. Okay. I did an episode on this one before, the Chat GPT one, when to hire an advisor. And I basically walked through, even if we're not the right fit for you, I walked through some resources in terms of how to find an advisor. So find one and consult with that advisor before you make any rash decisions. But again, it's better to do nothing during those types of scenarios, during a bear market, during a recession, than again, acting with emotion and making rash decisions. So I really caution all of you that doing nothing is certainly okay. And it's certainly better than totally blowing up a perfectly well diversified and thought out investment strategy that you may have had already. So that's it, everybody. That's the 14. I hope you all found it helpful. And, remember, listen, I don't want to dismiss anyone's emotions during this time. I know we're talking about, the unemotional, repeatable process, but I'm not the one that's retired. Okay. But I can definitely empathize with those of you that are retiring during these volatile times because I've helped people retire during volatile times before. I think back to 2022, 2020, 2018, 2014, I think it was 2008, 2009. I've been through it where folks have been transitioning from working to retirement. It's an emotional time. There's a lot of things going through your mind, not just on a financial front, but just thinking about this next chapter, thinking about aging, thinking about death or disability or incapacity. There's a lot of things on folks' minds as they approach this next phase, and volatility in the markets are something that is not comfortable to add on top of all of those things. So I don't want to dismiss any of you who are feeling uncomfortable at these times, but I would just encourage you to have a trusted partner. Have someone that you can lean on during these times that can coach you to make sure that you stick to a long-term discipline strategy. And if you want help with this, of course, I invite you to reach out to me. Go to my website, like I mentioned, www.imaginefinancialsecurity.com, or you can do the retirement readiness questionnaire in the show notes. We love to hear from our listeners. Truthfully, I was joking with Roberto about this. I want every single one of our new clients to come from our podcast or YouTube, because they're already starting to get to know our philosophy, our mindset, the way we approach financial planning, which we believe is very, very unique relative to the industry. And we want our clients and prospective clients to get to know us before they hire us, because at the end of the day, you're hiring someone virtually that you've probably never met in person. And so we'd love to hear from you all. And if you are interested in starting that process, just fill out that retirement readiness questionnaire that's linked in the description. We'd love to learn more about your situation and see how we can help. But again, I hope this is helpful. Let's see where we go from here. Okay, listen, I'm cautiously optimistic. Regardless of who's in office, I'm always rooting for America to win, to be safe and secure, and to have long-term prosperity for the future of our children, and my kids. I think whatever happens, wherever you sit on the political side of things, hopefully we can all agree that as Americans, we want America to succeed. And I'm just cautiously optimistic right now. I definitely see the volatility. I see the concerns that the markets have. I see the concerns that my clients have. And I just think, having a process, having a plan, sticking to that plan is the only way to go during these periods of uncertainty. And so hopefully this episode helps you. If it did, I'd appreciate y'all if you want to leave a 5-star review for us. That helps us. Certainly we can reach more people and impact more people. It helps trick the algorithm. So yeah, if you found value in this episode and you find value in our content, make sure to, of course, follow the show. And you can certainly leave that 5-star review. We greatly appreciate all of you that have done that up to this point. Until next time, I'll see y'all next week. This is Kevin Lau signing off.